Folks, welcome to episode 26 of the Tailored Tax Show. This is the podcast that helps highly paid, highly taxed, high profile, high net worth, and ultra high net worth taxpayers save a bunch on taxes legally. I'm Terrence Taylor, the co founder of Tailored Tax, and I'm an enrolled agent. This is Big Al, Donnell Jr., my partner. Hey, Big Al, how you doing today?
Hey, bonjour. Très bien. I'm doing great, man. I'm Big Al and I love my mama.
That's right. That's right. In this episode, we're going to continue our series on retirement and taxes. And we're going to explain to you how you save for retirement in a tax advantage way when you get to level two. And Big Al is going to explain to us a little bit more about what level two is. And some of the things we want to make sure you get out of this is understanding what amount of money you should be saving in your for retirement when you get to level two, and the mechanisms that are available to you to be able to do this legally. And this brings up our first disclaimer and reminder for you. So retirement is a very specific area of the tax code, and we want to ensure that as you listen to what we're sharing, you take in the information in the way we intend it to be, which is to educate you on what's possible and what you should explore. If you want to act on anything you hear during this podcast, please consult with a qualified tax professional like us or your retirement planning specialist if you have one, or your financial advisor if you have one. Why? Because ultimately, whatever you do in this arena has to be something that's going to work out for you and your specific situation and circumstances. All right, Big Al, I've said a lot. Let me hand over to you. Tell us, what are we talking about today?
Well, we're talking about the level two of taxes and retirement planning. The last podcast, we talked about level one, which was primarily qualified accounts. Qualified accounts are just accounts that the IRS has qualified as vehicles for you to grow your retirement investment without the earnings being taxed. So now level two is what we're calling equity centers. And with these equity centers, these are not government created accounts, but they're more so private accounts that grow in equity and value, hence the name equity center, that you could then utilize to pull loans from and live off of. All right. And the beautiful thing is that it puts more control in your hands so that if you were to pull loans out and never pay it back until you pass, then it's okay. It just reduces whatever that equity was in that account, and it'll be paid off once you pass away. So here's the thing is, and I think Terrence alluded to it, what transpires between going from level one to a level two in this tax and retirement plan strategy that we're talking about. That threshold, we actually just looked it up. It's about $80,000 to $100,000. Whenever you have a little over $80,000 to $100,000 or more to put away for your retirement, then that's when, that's one of the thresholds to start going into level two. And to be honest with you, even if you're not putting anything into level one, you can still start at level two. All right. But we're just saying, as a good rule of thumb, from a financial threshold, about $80,000 to $100,000, and that being a $69,000 cap in a solo 401k or SEP IRA, a $4,150 cap in an HSA, and a $7,000 max or cap in an IRA, and those are all for single individuals. Of course, if you have a spouse, that's per individual, and then on the HSA, the family amount is $8,300, which is twice the single amount. And then if you're over 50, you could put 76,500 away for a 401k and 8,000 for an IRA, and this is all 2024 numbers. So now, jumping back into it, so let's talk about very quickly, what are these equity centers that we are discussing? And these equity centers, matter of fact, I want to start off with one that Terrence is intimately familiar with, and that's cash value life insurance. So, just to quickly go over what those 4 or 5 are: cash value life insurance is one equity center, real estate is another equity center, your company, which you could pull loans from, is another equity center, your brokerage account, and then also I want to throw in here a defined benefit plan, which is separate from a defined contribution plan, which is level 1. So, Terrence, if you could take away, could you tell us a little bit more about tax planning for retirement using cash value life insurance?
I'll be very happy to, Big Al. And folks, another one to potentially consider, which we'll get to in the end, is private equity. But that's a
Correct.
very specialized case. Okay, so let's talk about cash value life insurance policies. So with cash value life insurance, there are different types of products. So some folks are more familiar with whole life insurance. Some folks are more familiar with variable life. Some folks are more familiar with universal life. And my favorite of this category is index universal life. Why is cash value in life insurance a way for you to potentially save for retirement? Well, the first thing to say up front here is you must have what's known as an insurable interest for you to be able to get a life insurance policy, right? And we're not going to get into the nuances around this. If you're interested, please feel free to get in touch with me, Terrence at taylortax.ai. I'm a licensed insurance agent, so I can assist you with that. But for the benefit of this particular podcast, here's where cash value life insurance becomes an equity center. Once the policy is set up, because it has cash value, you are able to borrow policy loans against the life insurance policy. And once you're able to access these loans, the loans can serve as money that you could use for retirement, and you could structure your life insurance policy to have these loans that start to pay you at different stages. And the best part about cash value life insurance that makes it a level 2 way to think about retirement and taxes is as and when you pull out the loans, the money in your hand is actually tax free because it's a policy loan and you're expected to pay it back. Now, the way the policy will be structured would be that the loans will be paid off by the death benefit. But again, I don't want to rabbit hole into too much details. The absolute best part of cash value life insurance policy and why I love index universal life policies for retirement is they allow you to have a lot more control over how and when you access the funds and for what purposes you access the funds. Because once you take out a policy loan, you have complete freedom in terms of how you spend that money and what you spend that money on. And with index universal life as well, the way it's structured is it actually has downside protection because your premiums are not invested in the market. They are behaving as if they're invested in the market, but they're actually not in the market. So if the market ever goes down, whereas with 401ks and other instruments that invest money in the market, like variable life, for example, you end up losing money. But with index universal life, you don't lose money. So you just get zero for that year, and then your money goes back to compounding and growing. Okay, Big Al, I've said a whole lot, but that's
No,
one of
that's
the
great.
reasons why we love this particular policy. And just to be clear as well, we want to be as helpful as we can, and we want to give you information that ultimately helps you legally, as we always say, and perennially save on your taxes. So we actually checked out a few court cases where the IRS has actually weighed in on when people have misused life insurance policies, for example. And so we want to make sure that you're clear that in order to use this particular strategy, you must make sure that the reason why you're taking out the life insurance policy is because you have something to protect. So whether that's an asset, a life, or something with economic interest. Otherwise, the IRS will deem you to be purposefully taking out life insurance for tax avoidance, which is not legal. So just want to be very upfront about that. Okay, Big Al, back over to you. Take us to the next one.
Definitely, definitely. And thanks for that disclaimer. So the next one is this is real estate. All right. So real estate. And by the way, for these equity centers, I look at it from this aspect of it has to be able to produce revenue. It has equity that grows or value that grows, and that you need to be able to take a loan or against it. So real estate, we know, encompasses all three, just like the IUL policy that Terrence mentioned earlier. And with real estate, the biggest thing that I want to impress upon you is to make sure that you delineate the mortgage interest properly, because you cannot write off mortgage interest that you're using for something outside of the real estate as a real estate write-off, even if it's an investment property. All right. So it's not like, hey, I got an investment property that's worth $500,000. I got $100,000 in equity. I'll pull out 50 grand to invest in the stock market, and then I'll write it off as mortgage interest against my property. That needs to be properly classified as investment interest associated with whatever you invested that money in, if it's not the home. So that's the biggest thing with real estate. But as you all know, real estate, it grows in value. You also get the added benefit of depreciation expense, and you can pull loans from that real estate to invest or to live off of, et cetera, et cetera. The next thing are company loans. All right. We own a company, Taylor Tax LLC. We also own other companies outside of that. And if the company has assets in it or basis or cash in it that you are able to access, there is a way that you could pull a loan from that company, a shareholder loan, in order to assist you during retirement. All right.
Mm.
But once again, you need to make sure that you have the proper paperwork in place to show that you are being charged a going rate and not some human like extremely small amount. It needs to be a market rate. And then also you need to have some sort of plan on when you're going to be paying it back, the term of the loan, and so forth. But nonetheless, it's another equity center because it's something that holds value.
Yeah.
And you could get the business valued as well, and then use that business valuation to get a loan, from a bank against the value of your company. All right, so next is going to be margin loans, and I want Terrence. Are you cool with talking about that one?
Yeah, let me talk about this. So, folks, margin loans, this is where we have brokerage accounts and we're able to borrow against the value of the accounts and on margin, or borrow on margin for those who are more familiar with talking about it this way. And again, here you're able to access those funds and you can then use the funds as you need. If for those who have brokerage accounts that have a large amount of money in it, you sometimes are able to borrow 40% or more uh, of what is in the brokerage account. But there are pros and cons when it comes to using brokerage accounts if that's how you want to access money for retirement. The asset that you have is invested in the market, and the market goes up and down. And if it turns out that you borrowed, for argument's sake, you have 100,000 in the brokerage account, you borrow 40,000, and then the market goes down 30%. So now, as opposed to 100K, you have 70K. And so 28K would be what you would have gotten out on margin loan. So now you got to pay back 12,000. And as we know, for those who have experienced it, when you get a margin call, oftentimes you're selling assets to pay that loan, but now the asset value is decreased. So this does have some risk. So you want to really think this through and make sure that this is something that would work for you. Yes, the positive, of course, is that it's a lot more flexible, and it also allows you to access the money relatively quick. There are tax implications, of course, if you are selling assets as well to cover your margin loan, because then you're going to have to pay potentially taxes on those assets depending on your cost basis. So again, wanting to keep this high level and not pigeonhole. If you're interested in discussing this as a strategy, talk to a qualified tax professional for the tax angle, and talk to a financial planner from the investment angle. Big Al, let me hand back over to you. Tell us about these qualified benefits plans.
Yeah. So with a qualified benefit plan, which is quite different from a qualified contribution plan, benefit plan means that, hey, you are not putting money away. You're not contributing to your future retirement. Your company is putting money away to define the benefit that you're going to receive after you retire. And these are the proverbial pensions that our parents had and those of previous generations. But if you are solo entrepreneur, you can set these things up, or if you only have a few employees. And the beautiful thing about this is that you can contribute, or the company can contribute to this defined benefit plan up to $275,000 or 100% of your earnings each year. So that blows out that $80,000 to $100,000 threshold out of the water, which is why we're labeling this more in the level 2 of taxes and investment taxes and retirement planning, just because you get to put so much money into this bad boy and let it grow tax free before you pull it out. So before you pull it out. So that's the defined benefit plan. And then finally, we'd like to talk about private equity funds. So I'll start it off, and if there's anything that you want to jump in on, Terrence, just let me know. But with a
Sure.
private equity fund, all this means is that you and some other investors, accredited investors, get together with your own private funds and start a fund where you're directing your investments in a particular area. All right. The private equity fund could just be for real estate. It could be for certain types of small businesses. It could be for, I don't know, what's that thing called when you're not social emotional, social justice, not social justice, but
ESG? Are you thinking about ESG?
ESG. Thank you. What's ESG stand for again?
If memory serves me,
Economic, social, and giving, or I don't know.
and it was an environmental,
That's
social,
it.
and governance, I think. But
Yeah,
like,
exactly. That's right. So it could be environmentally focused,
mm,
what your private equity fund is doing. However, with a private equity fund, the money that you put in usually has to kind of jail in there for close to 10 years or more. However, once you have the investments that are returning more of a stable return, then there are things that you could set up, like a capital call line of equity. And there's other ways to make the funds that you invested more liquidable to yourself while the money still stays in. I guess the primary principal amount stays in to continue making money. But there's
mm,
ways that you can make it more liquidable so that you can access it during retirement. So,
mm,
but once again, that's a conversation with your tax advisor, as well as the firm that you're using for the
mm.
private equity company.
Yeah.
So yeah, that's it for me. Anything you want to jump in on
Yeah,
that?
the only other aspect to add with the private equity is make it more liquid, just the terminology, Big Al. So second, but more exciting, you have the opportunity to get a lower tax rate
Yeah, yeah,
with private equity funds, as we've
definitely.
spoken about previously. So with this carried interest provision in the tax code for private equity, you get the opportunity to be taxed at 20% as opposed to ordinary income, which currently is 37%. So at least as things stand today. So folks, that's what we wanted to share when it comes to retirement and taxes. And again, to close with this disclaimer, this is for your information to open your eyes to different ways that you could save for retirement than the traditional way, which tends to be the qualified plans we spoke about in level 1. And as you consider the information here, please think through your own individual and unique circumstance and figure out whether this is something you want to do. And if it is something you want to do, then consult with a qualified tax professional like us. So you can reach out to Big Al at taylortax.ai, or to me, I've already given you my email, but Terrence at taylortax.ai, or any qualified tax professional that you want to work with. Also, consult with your financial planner and or retirement planning specialist if you are already working with one or would like to talk to one. All right, folks, thank you so much. We'll see you soon.
Cheers.